complicated and I think 2 notches more insightful than much of what has been written about the financial crisis cause. Tam makes the link in a way that I think many of us find intuitive, but has never been really as documented or articulated as he does in Unfinished Business. That it was a combination of the deregulatory wave that hit both Western Europe and the US much before the crisis that led to excessive sales of bad loans or potentially bad speculative investments to European banks who were flooding the American financial system with money. And I'm doing this much worse than Tam will and do it in a moment. But then the repercussion was the deregulated American banks were selling their garbage to the European banks, and this led to a feedback loop such that the real estate crisis in the US and the banking crisis in the Eurozone were fundamentally linked and go back to much of the deregulatory initiatives. And again, for me, intuitively as well as empirically, I would have liked to have made this case myself had I been clever enough. And Tam does an outstanding job of bringing together historical, econometric, and legal evidence to explain why this slightly more complicated, but focusing very much on the fundamentals reason for the crisis is there. And this is, of course, in contrast to the views that it was lax monetary policy or just on one side of the Atlantic or due to foolishness on the part of savers. All of those may be part of it, and Tam does not rule that out, but I think he makes an extremely compelling case that the story he tells from deregulation to the cross-Atlantic flows is the key part. Tam Bayoumi is, of course, in the surveillance team, is deputy director at the International Monetary Fund, working in the SPR. He has been involved in overseeing the fund's surveillance strategy. We were fortunate to have him come to us on sabbatical in late 2015 for a year, and even more fortunate and impressive that he completed this book in that year, an object lesson for all us fellows who are here full-time and somehow don't manage to do that. It was wonderful to include myself in that list, by the way. It was wonderful to have Tam in residence as a colleague, and we continue to value his interactions and his insights as he's returned to the fund in his very senior role. But today he is here as an independent author, speaking only for himself in the best Peterson Institute tradition. Tam, please come up and give us your introduction to Unfinished Business.
Well, Adam, thank you very much for that very kind introduction. So to start with the boring bit, although Adam sort of said it already, this is my own views, not those of the IMF or of the Peterson Institute for International Economics, which I spent a very happy year in. I owe a tremendous debt to lots of people. I owe a particular debt to Adam. And the reason for this is lots of people told me what should be in the book. Adam was the only person who told me what shouldn't be in the book. And if he hadn't cut down my grandiose vision, I would never have finished this book in a year. And therefore, I owe a tremendous amount of thanks to Adam for his insights. I guess the key question to start off with is why another book on the crisis? And I'd like to give you 2 reasons for this. One is that I think the true size and importance of the crisis is only becoming more important, is only becoming apparent over time. So to take a broad simplification, before 2008, people regarded the economy as being one of ever ongoing prosperity, and that policymakers were tweaking it to make it ever better. After the crisis, I think that the view has been much more of a new mediocre, low growth, and increasing questioning of expertise. And of course, the social and political consequences of that we're still seeing ramified to this day. So that's one reason. The second reason is I found the existing literature to be slightly frustrating. The reason for this was that almost all of the books on the crisis were about what happened over the crisis. And furthermore, they focused either on the US or on the euro area. What I wanted to do was write a book about how the crisis happened, and in particular, as Adam mentioned in the introduction, say that there was actually a North Atlantic crisis. This was not a US crisis followed by a euro area crisis. The two were umbilically linked. And so to take a parallel from a different literature, that on the First World War, I wanted to write about the origins of the First World War, not about the First World War itself. And I also didn't want to write about either the Eastern or the Western Front. I wanted to write about the origins. So that's sort of what went on. So the basic question I asked myself was, how did the bankruptcy of a medium-sized US investment bank, Lehman Brothers, bring about a deep, deep recession over the entire North Atlantic region, and at least in the euro area, a full depression? The answer to this, in my view, is a series of regulatory errors that started as early as the 1980s. And already by 2002, on either side of the Atlantic, you had destabilizing or increasingly fragile, maybe, banking systems. So in 2002, in Europe, you had increasingly expansive large banks who were increasingly dominating the banking system and expanding. And in the US, you had an equally expansive and equally fragile shadow banking system. Then in 2003, an obscure change by the SEC, which I'll go into later, brought these two crises together. So to use another parallel from the First World War literature, in my view, after 2003, most of the actors in this tragedy were sleepwalkers. So let's start with the European half of the crisis. So essentially, what happened was in the mid-80s, European banking regulations were changed in a way that encouraged the large banks, which were mainly in Northern Europe, to move to a universal banking model, which combined commercial banking, that is, loans to firms or individuals, with investment banking, i.e. buying and selling of assets. And this distinction between commercial and investment banking will be important going on, so it's worth remembering it. These universal banks then prospered when in the mid-90s, the international banking regulations were changed, and they were allowed to use their own internal risk models to calculate the capital behind their investment banking operations. Unsurprisingly, given the ability to use their own risk models, they then manipulated these risk models in a way which allowed them to save on capital, become increasingly fragile, but also expand very rapidly. So if you want to look at the size of the European banking system, here is the EU banking system from 2002 to 2014. And it's divided into the blue bit, which is the rest of the system, and the red bit, which is the 12, what I call mega banks. These were the 12 largest European banks in 2008. Okay? And what you can see in 2002 is already, this was a very large banking system. This was about 230% of GDP. To give you an idea about that, even if you include the shadow banking system, this is over double the size of the US banking system. Okay? Now, between 2002 and 2008, it increased by another about 50%, and all of that increase occurred in the 12 mega banks. There was essentially no increase in the rest of the system. So here you can see the massive expansion in these very large banks in the euro area. Now, how did this come about? Well, as I told you, they manipulated their internal risk models. So what you can see here for 1996 is on the vertical axis, capital buffers as a ratio of total assets, and on the horizontal axis, capital buffers as a ratio of risk-weighted assets. And this is for the same 12 banks. In 1996, not all of them were extant. But what you see from these two different measures of capital buffers is exactly what you'd expect to see, a positive relationship. Let's fast forward to 2008. what you see is that these two different measures of the capital buffers are now negatively related. So in this world, there was a universal bank where €1 of capital supported 60 euros of loans. And this was regarded as much better capitalized than a commercial bank where €1 of capital supported 12 euros of loans. Okay. Now, no prizes for guessing which bank turned out to do worse over the crisis. So that's the European side. What happened on the US side? Well, again, the story here goes all the way back to the 70s, and although people think they understand what happened in the US, I think that it's equally misunderstood. So what happened in the 70s was the rise in inflation interacted with outmoded constraints on bank deposit and the interest rates that banks could charge on deposits to move deposits from the regulated commercial banking system to the relatively unregulated investment banking system. Now here it's really important to understand that in the US regulatory system, the commercial banks were under bank regulations, whereas investment banks, despite being called banks, were actually not under banking regulation. So they weren't under these deposit caps. So deposits moved from the commercial to the investment banks, which formed the core of the shadow banking system. Where deposits moved, loans followed. And this occurred through an expansion in the sales of loans through securitized assets. So what happened was the commercial banks were creating loans, in particular mortgages, and then selling them to the shadow banking system through securitization. To give you a sense of the size of this change, here is a picture of the US mortgage market in 1980 and 2002. The blue bit are the loans retained on commercial bank balance sheets, and the red bit are the loans sold to the shadow banking system through securitized assets. What you can see in 1980 is that the vast majority of mortgages stayed on the commercial bank's balance sheets. By 2002, well over half of all mortgages were being sold to the shadow banking system. So this is one of the reasons I say that by 2002, essentially the shadow banking system was in place in the US. Then what happened in 2003 was the SEC made a change to the rules on collateral for repurchase agreements. So repurchase agreements were a way of borrowing cash, and you borrowed cash and in return you temporarily loaned an asset to somebody else. Now before 2003, essentially the collateral you could use for these loans was very safe treasury assets. In 2003, the SEC widened this to two sets of assets. The first was all mortgage-backed securities, and the second was high-class foreign paper. And these were both to have profound consequences. So if we start with the expansion to all mortgage-backed securities, what you can see here is a picture of the US securitization market for mortgages. And up to 2003, and it's divided between the relatively safe mortgages guaranteed by the government-sponsored enterprises and the more risky mortgages provided through private securitization by the banks. Now, through 2003, while there was a private securitization market, it was essentially pretty small, and the vast majority of mortgages which were securitized were relatively safe mortgages going through the GSE system. What you can see after 2003 is a very rapid increase in private securitization. Why was this? Because remember that you could now use these assets and repo them to get cash. This liquefied the market, but it also meant that the people who were buying and selling these were often traders, and traders were interested in high interest rate mortgage assets. So this is the start of the subprime boom and other parts of the private sector market. So gradually, the securitization market moved from being dominated by safe mortgages to being increasingly dominated by unsafe mortgages. So that's the MBS half. The other thing which happened was a massive expansion of the Northern European banks into both the US and the UK, where they basically went into investment banking, but also into Southern Europe, where they went into funding bubbles there. So here you see, from 2002 to 2007, the foreign assets of the Northern European banks as a ratio to GDP. You can see that over this period, they over doubled, with a very large amount going to the US and the UK, where, of course, their internal risk models allowed them to expand into investment banking cheaply. But also, they were able to now take their Italian government bonds or whatever and turn those into dollars, which they then used to buy US mortgage-backed securities. And they also expanded into Southern Europe. So a very large part of the financing of the bubbles in both the US and in Southern Europe actually came from the Northern European banks. And this explains why a US and Southern European housing bust turned into a European banking crisis, particularly in the large Northern European banks. So, just to summarize this part of the story, so what happened was, up until about 2003, both sides of the Atlantic were the banking systems were becoming less stable. In Europe, it was happening in the core of the system as the major banks became less and less sound. In the US, it was happening at the edges of the system as the shadow banks became more and more important. This matters because that explains one of the reasons that in the euro area, it was so much more harmful, because it was the center of the system that got hurt over the crisis, not the periphery. And of course, in 2003, what happened was you set up the thing which parasitically intertwined these two increasingly unstable systems through repos going one way and mortgage assets going the other. Now, why did people miss this? That's the obvious next question. Okay. Well, part of the answer to this, at least in Europe, was why did people miss that the banks were becoming increasingly unstable, was that in 1992, the Maastricht Treaty kept banking supervision at the national level. This hardwired regulatory competition into the European banking system. So what happened was the regulators became boosters to their own national champions, as they called them, their own mega banks, rather than looking at their safety and soundness. So that was one blinker. But another blinker was actually the design of the euro area. So these intellectual blinkers either allowed you to miss things or amplified the costs of the crisis when it came. So one major amplifier was the bad architecture of the euro area design. So what happened was the single currency was always a discussion between the Germans and the French, who have completely different views about how what the single currency was about. So the French saw the single currency as necessary to create the integrated economy needed to have a single currency. Okay, and in that interim, to move from the less integrated to the more integrated, you needed to have support for governments. Okay, the Germans had a completely different view. In their view, you should only have the single currency once you've got an integrated economy, and therefore you should avoid supporting governments because A, they didn't need it, and B, if you did provide the promise of support, they might do unwise actions. Now, what you got in the Maastricht Treaty was basically the worst of both worlds. You ended up with a French early EMU, but with the German no bailout clause. And that explains why it was so difficult to reform the euro area system over the crisis. And those tensions between the French and the Germans can be seen to this day, and I'm happy to talk about that later. So what else was going on? Well, another blinker was a very strong belief, particularly in the Federal Reserve, that investment banking, and in the end all banking, was better controlled by market forces than it was by government regulation. And this explains why the Federal Reserve in particular pushed for the use of internal risk models. It's important to understand that in their view, not only was it market discipline an adequate way of controlling the risks taken by investment banks, but indeed that government regulation might create bad incentives. So one of the ways to think about internal risk models is that they were actually there not to improve banking regulation, but actually largely get rid of it. Another intellectual blinker, which I discussed briefly, was also the central banks had a very strong belief in the efficacy of monetary policy. And this led them to believe that even if there was a bubble, and they thought there weren't bubbles, but even if there were bubbles, they were best dealt with after the fact, rather than by taking preemptive action. A spectacularly bad reading of the situation. A final blinker, which I want to spend a bit more time on, given I'm at the Peterson Institute for International Economics, is the there was a belief that the spillovers across countries were low. And this was because the models that were being used focus on trade as the linkage. But this was particularly strange because if you look at the history of the international financial system, there had been, from the 70s on, a whole series of large international crises whose costs were going up over time. And so what I'm showing you here is a whole series of crises: the breakup of Bretton Woods, then the Latin American debt crisis, then the ERM, then the Asia crisis, and then finally the North Atlantic crisis. And I've got an approximate measure of the costs. Okay, so there was a fall in global demand, which is divided between a reduction in growth in the countries involved, that was the domestic cost, and then a reduction in their current account deficits, which was a cost to the rest of the world as demand went down to the rest of the world. And what you can see over time, as capital becomes more mobile, is that the costs of these crises went steadily up over time, ending up with the very large cost of the North Atlantic crisis, which is around 3% of global GDP. Okay? So, and another thing to notice about this is that it starts in the advanced countries, then moves to the emerging markets, then back to the advanced countries, then to the emerging markets, then again to the advanced countries. This is very different from the pre-crisis story, which was basically saying that most crises occurred in emerging markets. So, if that's my story, what do I think has been the adequacy of the response to these problems? Well, I think if you take my story in the US, the basic problem was a difference in regulation between the commercial banks and the investment banks. The investment banks had lower regulation. This is what incentivized securitization. Understand that the securitization market had no real economic logic. It was pure regulatory arbitrage, as the investment banks had less capital behind these loans than the commercial banks were forced to hold. So here, I think there's been a very positive development in terms of the fact the investment banks are now under exactly the same strengthened capital regulations as the commercial banks. So essentially, the shadow banking system, at least as it existed before the crisis in the US, is essentially a thing of the past. If you turn to the Euro area, however, I think that the story is much more mixed. So it is certainly true that there are much higher capital requirements for the Euro area banks, but to this day, the only requirement, the only capital backing that's required by the regulators for the European banks is still internal risk models, okay? And now, this is supposed to change in 2018, and we'll see what happens. But as always, the devil will be in the details. And so we'll have to see whether the final version that comes out in 2018 actually really solves this internal risk model problem. If you turn to another weakness in the euro area, which was supervision being at the national level, supervision has been moved to the EU-wide level via the ECB, so that's good. But against that, the support for banks that get themselves into trouble is still at the national level. And that creates a whole series of other odd incentives. So until we get a true banking union with centralized support for banking crises, I think that the things are only half finished. If you come to the EU architecture, again, we now have a process to provide support for governments that get into trouble. But again, they have to be prepared to submit to a program and sort of essentially admit they're in a crisis. So we're not going to get the preemptive funding that would be the least cost solution. So now if you turn to the intellectual blinkers, well, there's been an awful lot of work in macroeconomics about macro-financial linkages of one type or another. But still, if you look at the baseline models that are being used, they almost all still have extremely efficient financial markets. They still have very powerful monetary policy, and they still have very low international spillovers. So all of the things, assumptions which we found wanting over the crisis remain the stock in trade of most of the models that policymakers are using. It's often said that those who do not learn history are doomed to repeat it. What I've tried to tell you is a story which talks about the deep origins of the crisis so that we can learn from history. Now, what I've tried to tell you is that the crisis came from a series of blinkers, but in particular from a series of regulatory errors. Now, all of those errors occurred for understandable reasons. People had logic for why they did what they did. It just turned out that they didn't see the spillovers. This, I think, is actually a rather hopeful story, because what it says is, if it really was a bunch of errors, then you can reverse those errors. But of course, in order to reverse those errors, you have to understand what the deep causes were, rather than reacting only to the symptoms. And I think that thus far, the story on that is a relatively mixed bag. And that's why I still think there's a series of unfinished business. Thank you.
Thank you very much, Tam. People may have seen me, even though I was in the front row, sort of nodding with my whole body at various points. I think that was terrific. But let me start out by challenging you on a couple things, just so you can demonstrate your ability to fend this off before we turn it over to our audience. The first question is, so we have the story you're telling, and then we have variants on the global liquidity story. That it was, as Claudio Borio and parts of the BIS say, low interest rates, that it was China, I can't think of the term. Joe, what did you call it? Savings glut. Global savings glut. That Asia, going back even further in time in response to the Asian financial crisis, was saving too much. And then this money gets flowing into the US. Your story doesn't emphasize those at all. Why or how are those ideas misguided, and why should we believe your story and not those stories?
Well, let's start with the low interest rates. I do agree that low interest rates help to precipitate things, but I've never believed that if the US short rate had been 1% higher in the mid-2000s, this would have made much of a difference. What was happening was the liquidity was coming in large part from the creation of money by the private banks, okay? And it is certainly true that the low interest rates help precipitate the booms. But I think the fundamental cause of the booms was actually these forces which create an awful lot of private money. It was a private money story, not a public, not a central bank story. So while I don't discount that as part of what created the final boom, I don't think it was what created the basic problem. Turning to the financing, let's start with the easy bit, which is the euro area. Now, in the euro area, there was very large inflows into Southern Europe from the northern euro area banks. And this is one of the things. So in general, people say, how was Greece able to borrow compared to Germany, at the same rate as Germany, essentially, right? Well, part of the story is, of course, that everybody believed EMU and all of that. But part of the story was there were these massive flows coming in from the northern European banks. And of course, that made easy lending conditions in Southern Europe, which lowered the interest rates. So I think that that's an important part of the story. Turning to the US, I have an analysis of the inflows into the US. And it turns out that certainly the savings glut was an important inflow. But actually, the increase in Northern European bank assets were approximately the same as a ratio to GDP. And there was also a massive increase in the size of the repo market at the same time, which also made things more liquid. So while I don't deny that part of the easy financing conditions in the US came from the emerging markets, the savings glut, I think that a more important part came from the European northern banks, and that even without the savings glut, there would have been some kind of bubble in the US.
Very helpful. So second sort of challenge, again, focusing on Europe. So you mentioned the flow into Greece. So let me put it to you as provocatively as possible. If they had done EMU without this kind of deregulation or without this national championing of northern banks, would Greece have avoided the crisis? Would the euro area be fundamentally more sustainable?
Yes. As I say, my story is one where what happened was the creation of increasingly amounts of private money helped drive the bubbles that came. So in Greece, it turned out to be the central government that was borrowing. In Spain, it turned out to be the cajas that were using the money. In Portugal, it turned out to be some combination of governments. In Ireland, it turned out to be the banks. All of these bubbles had different sort of immediate causes, but they all occurred at the same time. And the unifying force was the large amounts of money coming in from the Northern European mega banks.
So again, just to push you on this a bit, because we had Klaus Regling here a couple weeks ago celebrating the fifth birthday, I should say, of the ESM. So are you saying then that there really was no deep sin on the part of Greece, Portugal, Spain, Ireland? They could have been fine as Euro members if they hadn't been sinned against by the northern banks?
No, I wouldn't go that far. It takes two to tango. But the point was they were given the means to do what they wanted to do. I mean, there's also a story about why a lot of the constraints on using that money were ignored. There's the story about this, the Stability and Growth Pact and how it wasn't really implemented, which was, again, a Franco-German issue. But in essence, I think that there were very large amounts of money available to these countries, and unsurprisingly, they went out and spent it. And as I say, they spent it in different ways. I think one of the oddities about the euro area crisis is that because it started in Greece, everybody's assumed it was a fiscal crisis, when in actual fact, when you look at the rest of the periphery, it wasn't really a fiscal crisis. And so I think that the story that people tell about it being fundamentally a fiscal crisis is wrong. What it was a banking crisis, which came out in the fiscal account of Greece first.
Well said. Final question before I turn it over to our distinguished in-person audience. As you are aware, we are going to have the nomination of a new Federal Reserve Chair later today, unless President Trump changes his mind. You've spoken and you made it clear the asymmetry US versus Euro in terms of which banks were vulnerable and what progress has been made. Do you have any either recommendations or warnings for the new Federal Reserve Chair on what they should not touch because it might get us back into financial vulnerability, or what they should do further?
I think at present, my advice would be to leave basically well alone. There may be some excesses in the post-crisis regulations on some smaller banks, but in particular, there's been very, very loose talk, which I haven't heard lately, but it was certainly going on while I was finishing the book, about a new Glass-Steagall Act, right, which would separate the commercial and investment banking in some way, the regulation of the commercial investment banking. And I think that would be a very bad idea, given the history of the crisis was actually the division in regulation between those two.
Great. Let me turn it to our audience. Jessica has a traveling mic, but if you can walk to the standing mic, go ahead.
Nicolas Veron here at the Institute. Thank you, Tam, for a very stimulating book and for all the time you spent here. I have a further praise, a quibble, and a question. The further praise is, I think, compared with a kind of standard view of the story of deregulation, you introduce a difference between the story in the US and the story in Europe. And in the US, it's more driven by ideology and the kind of misguided understanding of the free market hypothesis. But as you demonstrate, I think, in Europe, it's much more driven by nationalism and banking nationalism. So the deregulation is not so much free market ideology, but just the inability for Europe to build a consistent framework. And I think your book makes a very nice story of this. The quibble is about Southern European commercial banks. And I think it doesn't subtract from your argument that the Northern megabanks were undercapitalized, to recognize that there were balance sheet problems early on in the Southern commercial banks as well. And I think what we're seeing now in Italy tells that story, because also a lot of the capital that these banks had was not really loss absorbing, for example, sold to retail clients and things like that. And I think that doesn't really change your big story. It changed some details of your argument on the division between North and South, even so that stylized division, I think, is entirely apt. The question is about the US commercial banks, because the story you tell on the other side is investment banks undercapitalized, commercial banks kind of adequately capitalized. And I would like to challenge that, or to ask you actually, because I personally don't have strong views. But in 2008, in 2009, there were very strong views expressed here in the US that Citi was bankrupt, that big banks were undercapitalized. And I would like to have your reaction to that debate at the time and how you view it now with hindsight. Thank you very much.
Please.
Okay, so let's start with the second. Yes, Citi did get into trouble at the time, and Citi was the largest US bank. Understand that there were two banks which actually adopted, in the US, which actually adopted the European-style universal banking model before the crisis. That was JP Morgan and Citi. Now, JP Morgan managed to avoid the problems because they got out of the subprime market in time. But Citi certainly did get into trouble. By the way, obviously, the size of the downturn in the housing market, there were also some other US commercial banks which specialized in mortgage lending, which got themselves into trouble. My point is, given the size of the downturn, though, the US market really, the US banking system really did pretty well. Okay, there were problems, but they weren't huge problems. And that, I think, goes to your second, one of your other points, which is, yes, the southern banks got them, the southern European banks got themselves into trouble. The Cajas got themselves into trouble. But that's what happens when you have a massive bubble and a collapse. What's striking to me, though, is that there was rather less of that than there was problems in. My point was to emphasize that those problems cascaded back into northern banks much more than you might have expected. And in many ways, I mean, take, for example, in Spain, the two major banks, Santander and BBVA, came through pretty well. Now, they were in the center of what was a massive housing collapse. So it seems to me that in both cases, you can make the argument that while there was damage locally, as you would expect with a bubble and a collapse, that actually a surprisingly large amount of that moved to the.
Okay, thank you. Next question, please.
Good morning. My name is Christopher Smart. I'm now with the Carnegie Endowment. I have about 10 questions, but let me stick to 2, if I may. One is more backward-looking in terms of the specificity, the specific causes of the crisis that you identified, and you sort of think back at the time about securitization and the internal risk models. In fact, the securitization itself wasn't really the problem. It was the bad stuff that was being securitized and the ratings that were attached to that, I guess I would argue. My question is, how at the time did we talk ourselves into internal risk models being okay? And then the broader, maybe more forward-looking question is, I think you've identified some things, it sounds like, that we need to look at that will help us resist the next crisis as long as it looks like the last crisis. But the bigger problem for all of us, I guess, is how do you listen to those distant voices in the back of your head saying, everybody says this is okay, but is it really okay, as we sort of brace ourselves for the next crisis? That's a fairly philosophical question, but as somebody who's looked back at the inner workings of what went wrong and how we sleptwalked, that's the past tense, through the problems as they were coming unraveled, what advice do you have for us to listen for the danger warnings when the next crisis comes along?
Can I, before you respond, Tam, I just want to tell a brief story on the value at risk models and then ask you to respond. So my first job after grad school, I was at the New York Fed. And at that time, Bill McDonough, the president of the New York Fed, was very active in Basel and the international circles. And he had a very smart person who had been a couple of years ahead of me in grad school, who I'm not going to name, working for him on developing these value at risk models. This was 1994. And I remember sitting in that person's office and then eventually getting an opportunity briefly to talk with President McDonough. And both times I sort of said, I don't get it. You know, why regulations about somebody outside preventing things? And I basically got laughed out of both their offices because obviously I didn't understand the sophistication of these models and so on. So I don't say that to say I had particular insight. I certainly didn't have any influence. But I say that as just an example of how even at very widespread, at a very low level, this culture, this idea that you wanted to shift the risk assessment into the banks was very strong. And just to amplify your point, Christopher, about just how this was an idea question. And if I can just rephrase a bit or reframe Christopher's second big philosophical point, another way of asking it, which I think is a great question to you, Tam, is how generally applicable is your unfinished business book? Is it about this particular financial crisis? Is it about financial crises in general in some sense?
Okay. Well, on the internal risk models, everybody became convinced, I think rightly, that the banks understood their own balance sheets better, and that they had these sophisticated models, and that those could be used to calculate risk. Now, I think that was right. Where I think the mistake made was to say that meant that you could calculate the capital based on them, right? And it's basically, it's a quantum mechanics moment, right? The observation changes the nature of the experiment. And basically, I think these internal risk models were good, and they're still being used in the US, despite the fact that there are all sorts of other capital ratios which the banks have to, because they are useful for internal calculations. But to then take those and allow the banks to essentially be able to use their models to define their own capital strikes me as a bridge too far. And I think it was slight naivete, frankly, in terms of the regulators thinking that if the banks were given this largesse, they wouldn't exploit it. I would like to go briefly into the securitization half of this. As I say, I think the argument for securitization was that it moved risk from the specific banks to the market as a whole. Well, it turns out that simply wasn't right. That what happened was you were moving the risk from the reasonably well-capitalized banks to the less well-capitalized shadow banks. But I think that the logic which the Fed used, and again, as I say, all of these errors had perfectly good arguments behind them. It just turned out that most of those arguments were either wrong or didn't realize some of the consequences. In terms of the future, I think most financial crises that are really harmful have a couple of things in common. And the most important is an awful lot of creation of private liquidity, and that occurs through the use of leverage. Okay, so you have increasing amounts of private money based on less and less lower and lower capital ratios. What I've tried to do is to demonstrate how that general pattern occurred in this particular case. I think that that general pattern is right, and that if you're going to look for worries in the rest of the world, then you need to look for that general pattern happening. So, for example, people bandy around shadow banking very, very generally nowadays. And a lot of what they call shadow banking, which is, for example, selling securities where the underlying assets aren't particularly are fairly illiquid, that to me is securities regulation. It's not shadow banking. Shadow banking should be about people effectively taking deposits and effectively making loans. This is really about bad practices in the securities market, and that to me is a different problem. It may be an equally relevant problem, but it's a different problem from what we faced before the crisis. So again, I think a certain amount of precise thinking about what happened is very useful in terms of answering what we should be looking at now.
Very good. Please.
Bill Klein here at the Institute. Tam, I wonder if you could talk a little bit about where you see the adequacy of the regulation at the moment. It does seem to me that even with the leverage requirement that will come into force in 2018, so 3% of total assets, 3% of exposure, which works out to about 5% of total assets. That still seems to me to be pretty slim. It ought to be 7-8% of total assets. B, in this year, we were supposed to finish up Basel III and do what the banks call Basel IV, which was to require that these internal models have a floor to how much lower than the standard risk weights you can apply in each category. And the Europeans were dragging their feet on that. But now this country is going in the opposite direction. It wants to weaken the stress tests. It wants to weaken our interpretation of the leverage ratio. So what's your take on the adequacy of the European capitalization, and what's your take on which direction things are going here?
Before you answer, Tim, I have to remind people that we published Bill Klein's excellent book on bank capital standards in June, and he just published an op-ed, I believe, in The Hill, was it, or Politico?
American Banker.
American Banker, in the belly of the beast, talking about capital standards in this vein. But we're here to hear your views today.
Okay. Well, you took the words right out of my mouth, Adam. I was going to start by mentioning Bill's book. So
It's my job, not yours. That's
which I also like very much. I was at a conference a few weeks ago at the CEPR talking about 10 years after the crisis. And somebody pointed out there was this big division between the regulators who thought the capitalization was basically fine and the economists, most of whom thought the capitalization was inadequate. I argue in the book a couple of things. The first is I think what the US has done thus far makes a certain amount of sense. So what the US has done is the US banks are actually under the large banks are under three capital standards. They're under their own internal risk models, but they're also under the standardized risk weights that our smaller banks are supposed to follow. Okay, so they can't manipulate their own internal risk models because they're also under a separate standardized calculation. They're also under a fairly meaningful, in fact, a meaningful leverage ratio of 5% on total and 6% on commercial banking operations. That strikes me, you can argue about the exact levels, but that strikes me as a sensible thing where you have sort of both sides being fairly large and likely to bind if the other one goes out of whack. So that strikes me as a sort of balanced approach. As I mentioned, in Europe, to this point, they are still under internal risk models. There is this debate about whether to put floors on the internal risk models so that you can't cheat too much. I think obviously that would be a really good idea. There's also, as you say, discussion about bringing in the leverage ratio. Like you, I think the leverage ratio is probably somewhat low. I quote a study by one of the many European bank regulators looking at this, saying that leverage ratios seemed to be fine. The main people it would affect were the large internationally exposed banks. That tells you that there is still an issue. In my view, that tells you there's still an issue with the large banks, because if that's the only people that imposition of this would affect. And as I say, I think you will have to see the details of what is actually implemented, because you can still implement leverage ratio, but do it in a way that it has less bite. So we'll have to see. In terms of the overall size, I really don't get into that in the book, because what I tried to do was make sure that the book told the story about all of the conclusions in the book came from the story I told about what the problems were. So it's clear you needed higher capital. I'm not sure that there's a logic from the story that I tell as to exactly how high that should be. What I do think you should probably have, because by the way, a pure simple leverage ratio, which is what the US had before effectively, also has its disadvantages, because you have incentives to move risky assets off your balance sheet. Okay, so, risk-less assets, low-risk assets off your balance sheet, and keep the risky assets. So a simple leverage ratio has its own weird incentives. That's why I think a combination of the two is probably better.
Very good. Any other question, please?
Dave Stockton here at the Peterson Institute. Tam, you touched on very briefly in your remarks of this lean versus clean debate in monetary policy, whether or not, and you indicated you thought it was misguided to think that you could just wait and sort of clean up the aftermath of an asset bubble burst. Does that imply that you think central banks should be more aggressive about leaning against asset bubbles? And if so, do you think they've learned how to calibrate monetary policy to do so? And what would be your advice there?
Okay. Yes, I think one of the lessons from this crisis is that monetary policy is not nearly as powerful as most of our models demonstrate it to be. Okay? Central banks have a lot less control over the economy than they think they do. What that does is that implies that if you see a problem, you should probably start dealing with it because you're much less able to deal with it if it gets larger. So my view is that in addition to macroprudential measures, which are obviously a part of the solution to this kind of thing, that a judicious use of monetary policy to limit private sector financial excesses is a good idea. I don't buy this separation between monetary policy should do only this and macro financial should do only that. I think that in the real world, you end up with using all policies a little bit to do everything.
But let me just push you a bit more on that. That's a different statement from the lack of empirical evidence that moving the instrument interest rate actually seems to affect these bubbles. And you started out your reply by saying central banks don't have that much power. So,
Yeah. I think there comes a point in bubbles where it's very difficult to do about them. That you just get into this kind of bubble mentality where everybody's pouring money in and then raising the interest rate 1 or 2%. Look, if you're really having people, as discussed in The Big Short, who apparently are buying assets despite the fact that it requires house price to go up at 10% forever, then frankly raising the US short rate by 1% isn't going to have much impact. There's a time before that when things are still relatively normal, when you can react. So this comes back to how far can you tell what's happening before. And then I would point to the recent Global Financial Stability Report by the IMF, which has a chapter on, a very interesting chapter on what's called GDP at risk. And what they do is they use quantile regression to look at if leverage goes up, for example, in 2 or 3 years' time, is there a larger expectation there'll be a big fall in output? And they find that there is, at least for both advanced and emerging markets, although for emerging markets it's a more complicated story. So it seems to me that argues that you can have some kind of forward-lookingness and that you can do something about it.
okay. Another, please.
Martin Chorzempa here with the Institute. I wanted to ask you about the role of ideas, something that we just touched upon, and specifically coming back to one of your earlier questions, which is how does Lehman lead us into this mess that we got into? And I wonder if you could talk a little bit about how we use ideas to help make sense of a reality in which suddenly uncertainty has a discontinuity, where you don't know who all the counterparties of Lehman are, you don't know where the spillovers are going to go, so you immediately go to too big to fail. And how the bailout before of Bear led people to have certain expectations in one way that suddenly were dashed. And so my question would be, one, what ideas do you think we need to deal with the shifts in uncertainty we might have in the next crisis? Actually, I'll just leave it at that.
And putting it also just one step less abstractly than Martin raises, I and a few people have kept saying the great missed opportunity was between Bear and Lehman. But your story seems to say, well, at that point, there wasn't really that much anybody could have done. I'm extrapolating. I'm not quoting you, to be clear.
Yeah.
So both in terms of the ideas that Martin raises, but also in practical terms, once you've gotten to the Bear Stearns situation, you have 6 months, 5 months before Lehman goes under. Is there something the Fed, the ECB, somebody should have done at that point?
Yes, they shouldn't have let Lehman go bust. Part of the story about this is the intellectual blinkers that I talked about, which I'll come back to in a second, meant that there were an awful lot of preventable things which occurred. And one of them was, if Lehman Brothers had been a regulated bank, you would have had procedures to keep it going even after it had gone bust.
Right.
Okay? That's what banks have. Okay? There's a bridge bank procedure which allows the bank to carry on exactly because the immediate shutdown of a bank has very wide consequences for the financial system. Lehman Brothers was not under that because it was not a regulated bank. Okay. And as a result, there were enormous costs because all of a sudden the market collapsed. Now, going back, so if you had realized that, then it seems to me that the view would have been, despite I understand that Paulson was under a lot of pressure from people who are saying you were bailing out everybody, that if you'd realized this, you'd realize the costs of such action. You would have done a lot more than was actually done to try and avoid the bailout of Lehman, or at least control the costs of it through emergency legislation or something like that. So I'm certainly not saying that the collapse of Lehman didn't add to the costs. I think it did enormously add to the costs. What I'm saying is something bad would have, I mean, there was already a US housing collapse happening before Lehman. Lehman just added the finishing touches, okay? I think the cost would have been lower without Lehman. And that brings me back to the original question, which is what were the ideas? Well, in essence, the original ideas were a very strong belief that market forces in some way were largely benign and could look after risks. Okay, that was essential. It's the sort of Reagan Revolution view. Okay? And that drove a lot of this stuff, deregulation, you name it, etc. Okay? I think in macroeconomics, what we're sort of stumbling towards is a rather different view in which you take a look at the private sector and don't assume that everything that it's doing is perfect. And that instead of that, you think that there's a legitimate role for regulation, particularly financial generally. And I'm not sure that that's quite got the articulation that will allow a sort of an intellectual consensus around that. But that seems to me where to go. I think that's right. I mean, look, the reason for the Thatcher Reagan revolution was that the earlier mixed economy had proved to be a failure. Okay, so the oil crisis just made clear that the earlier mixed economy was a failure. So the Reagan-Thatcher revolution said, get rid of the government from the economy. Well, in the end, this produced a larger crisis. So, presumably we need something closer to the middle.
Terrific. All right, I think we're going to end it there, but for the umpteenth time, but not as many times as deserved, I encourage you to read, to buy, to retweet, to speak about Unfinished Business by Tam Bayoumi. We're very proud and pleased that he did this research and wrote this volume while a visiting fellow at the Peterson Institute, and we look forward to it having a continued influence on the debate over financial matters in the years to come. Thank you, Tim.